All right, there it is. Oh, Danny Moses looking all serious there. It is April 18th. It is tax day. It is market call here. I'm Dan Nathan. That's Danny Moses. You know him. You love him from the On the Tape podcast. And as Guy would say, the Big Chill fame. But we kind of put that thing to rest, didn't we, Danny? The Big Chill thing, that's over, right? Because Guy finally watched the movie. He had a little bit of a cry. You laughed. He cried. That was great. Okay. Today's market call is brought to you by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Please subscribe to our YouTube channel. It's right here at Risk Commercial Media. If you're watching this right now, you're watching it on YouTube, but subscribe to that. There you go. Jacob's got a little ticker thing down there. All right, Danny, thanks for stepping in here today for Guy Adami. It's kind of one of those days in the market where it's like, I don't know, we're like the S&P, we're going to hit all the futures. We're going to kind of focus on the charts in a second here, but it feels like it doesn't have a bit of a theme here. You know what I mean? We're gotten through some of the bank earnings. I know we want to talk about that a little bit later. What's your take here? Because, I mean, for me, things are about to get real as far as earnings. You've been saying that on the podcast for a while. We've been obsessed with the macro. We've been obsessed with the Fed. But now really what's going to be most important, going to take center stage, is what companies are saying and the sort of visibility that they have.
Yeah, I think equity bulls are kind of hoping the banks aren't great, have a little bit of a drag effect on both the markets and the economy, so that the Fed will stop. In the last few days, the banks have been fine, kind of in line, maybe a little bit better. And again, this just started in mid-March, remember, the whole debacle. So you weren't going to start to see an impact really yet in Q1. You did see the big banks get bigger as far as it goes for deposit gathering and so forth. But I think now we've seen Fed fund futures now ramp into a raise here for May 3rd. And that's going to put a cap, I think, on the market for now, because I think people that are looking for kind of a soft landing or some landing at all were hopeful that we'll get a nice bounce. And now it appears that things aren't, quote, breaking, at least today. So that'll lead people to believe the Fed's going to go. And I think that's kind of going to cap the equity market here. And we're having trouble getting through that kind of 4180 level, right, which was the high that we set several weeks ago, which I still believe is kind of the big number to kind of get through here. So a lot more earnings to go through, Dan, but I think as expected, maybe just slightly better what we've seen so far.
Yeah, and let's pull up the CME Fed Watch tool here. That's something we quote a lot. And I think to your point, Danny, like we've just seen a rate move here. You know, a lot of the Fed speak has been particularly hawkish, and the fact that we haven't seen, data, a lot of that we talked about CPI and PPI last week, neither one of them surprised meaningfully, right? One way or the other. And so we've seen Fed speak that's been hawkish. We've seen the probability of that May 25 basis point hike increase here. And so, is a pause on the table as we get into June in the summer? Sure. Okay, fine. And we're going to be above 5% in Fed funds. We also have a CPI that's at 5%. We talked a lot about that on Fridays on the Tape podcast. Let's talk about sentiment, because this is really important here. And, this is a headline from Bloomberg here, and it's quoting, the Bank of America. They do those fund managers surveys here. Investors are the most bearish on stocks versus bonds since 2009. And I think versus bonds is kind of the important part here. Danny, when you see data sets like this, okay, what does that kind of make you think? Because a lot of people think 2009 and they still think the financial crisis. I think 2009, and I remember a bottom that happened in the market in early 2009, right, in the spring. And then I remember everybody and their mother hating the rallies, saying the bear market is not over, right? But that was it. And we never really retested. And so a lot of bulls, are suggesting that that might be the sort of sentiment environment we're in right now after last year. And maybe to your point about a recession, whether it happens or not, a lot of the bulls are saying that maybe those October lows priced in a recession, even a mild one that we would have in 2023.
Well, let's keep in mind, in 2009, rates were zero. There was no real alternative to equities. Bonds present a nice alternative to equities with yields of 4 to 5% on an annualized basis. So that's a big difference. I'll note that BlackRock is now going against their 60-40 recommendation. The 60-40 trade, which is 60% equity, 40% bonds, is up something like 6.3% this year after being down 17% last year. That's been kind of the traditional allocation. And it's ironic to me that BlackRock is actually saying go sector specific, look at healthcare and energy almost become a stock pick, or we're talking about the largest ETF manager in the world. And then within the fixed income world, they're saying inflation-linked bonds, right? And they're saying short-term bonds. And so they're being now very strategic in nature also. So I just think, yes, I think we're going to get back to the stock pickers market, which you've kind of lost during kind of Q1, right, where money just was kind of flowing into sector. But I do think when you see something like that in 2009, there was no alternative. So that was true cash. And so I think it's going to take a lot for people to pull money out of the bond market thinking they can achieve a better risk-adjusted return on the equity markets from here, Dan.
All right, so here's a question, and this came from a friend of mine who's not in the markets, okay, not like professionally, okay, but he is in as far as an individual, and he's sitting on a bunch of cash. He wants to get back into equities. He does own a lot of equities, but right now he's sitting in 6-month treasuries. Okay, so here's the question for you, Danny Moses. He asked me, all of a sudden, okay, if this debt ceiling thing becomes a real thing, right? And if we get to a certain 2011 sort of situation where it really gets to the brink, where there's a debt downgrade, where there is fear that the US will not be able to pay its obligations, right? Because of this silly rule about the debt ceiling. What does that mean for treasuries? Like what does it mean? Because there's another thing, Danny, going back to 2011, the Fed was engaged with quantitative easing back then, and they are engaged with quantitative tightening right now. So for all this money that is moved into treasuries because of the alternative, because of the yield, what would a tripping of the debt ceiling and possibly a downgrade, right, of the U.S. government's rating, what would it mean for treasury? What would you think the knee-jerk reaction, or at least how will market participants how will they position into an 11th hour sort of situation, which is not too different than we had in 2011?
I think maybe the initial move is yields move higher, bond prices move lower, but I think you would quickly see a reversion to people buying as many bonds as they could. Correct. Because at the end of the day, if there's no faith in the U.S. bonds, then there's no faith in the U.S. equity markets. So money will come out of equities, in my opinion, and start buying bonds. Because if it does trip, if something does happen and we technically default, it'll only be for a short period of time. We've seen kind of the first shot across the bow here. Kevin McCarthy spoke yesterday down at the New York Stock Exchange saying we're going to pass our own version of the bill, which some of that stuff will never pass, obviously, in the Senate. So they're going to fire the first shot kind of across the bow, but at least things are in motion. So it's hard for me to even intellectually conceive that occurring. Yes, in 2011, again, different time period, right? Let's talk about QE versus QT to the point you just made. But I do think if you want to be dovish about it, it would, again, what maybe some equity investors want is it forces the Fed potentially to do something that they weren't planning on, whether that stop raising or even potentially cutting or officially stopping, to your point, Dan, the quantitative tightening cycle. So that's a very hard thing to predict. But any of that stuff that would occur, Dan, at the end of the day, if you can't buy U.S. treasuries, there's a big problem because throw everything else out.
Yeah, and I think your point's a good one. Normally, in a situation like that, investors would they would flock to buying treasuries, right? Because it's deemed to be the safest sort of asset out there. And if you look at the chart of the of U.S. Treasury yield, the 10-year back in 2011, it started the year 330. It maybe made a high at like 360 or something like that. Then it closed the year below 2%. Okay, so and that thing went for a little bit there. So that's kind of interesting. All right, let's talk about whatever that alternative is to bonds. Let's look at S&P 500, the futures here, because you just quoted the level. It was 4180. That was the high from early February. I will tell you this: yesterday on the program, I highlighted just how cheap at the money puts, okay, in the S&P 500 is. Looking out to May 5th, we know we're going to have more earnings. We're going to have a jobs report on Friday, May 5th. We're going to have that week. We're also going to have Apple's earnings, and then we have a Fed meeting. The at the money put, Danny, you ready for this? Is 1.1% on May 5th. Think about that, okay? So think about that. And so when you think about this chart and you look at that level that we've drawn here is just above that high from early February. If you were looking to kind of express a view in the futures market, okay, you would just stop if you were looking to short the minis right above those levels, right above those highs, right? What would you be doing there? If you're looking to short it, you're looking to play for a move back towards that 200-day moving average down there, just below 4,000, right? And then you'd stop it just above those prior highs. It's kind of a very similar trade here, just using a tight sort of stop. I know that you like to look at the charts here. there's the other way to look at this chart. You can say to yourself, okay, maybe all the stuff that we've talked about here is in the markets, right? And maybe the Fed is going to pause or start to kind of slowly normalize rates a little bit. Maybe the economy is not going to have a worse than expected, something worse than maybe a mild recession. And maybe that's what a bottom looks like in the S&P 500.
Listen, it's hard for me to think that's what a bottom looks like given, and again, when we move from a 17.5 multiple on earnings to an 18.5 multiple on earnings, that's north of a 5% move, all things being equal in the S&P, right? So that's a substantial kind of move. But at the end of the day, whether it's 16 times, 17, 18, 19, it's kind of arbitrary because there's a camp that believes a soft landing and there's a camp that believes we're heading into recession. There are still, to me, the most important economic indicators, and that would be the labor market, I think is starting to show signs to me. And also, if you add in kind of the layoffs that have been announced that are out there or on the come and still going to happen here, I think we'll get more during earnings season of that kind of outlook here. Portend that the economy is going to slow from here. And again, how much does it slow? What rate of change we see? I don't know. But either way, it does not justify, to me at least, where the equity markets are trading. So if you're asking me to pick a side, Dan, I'm going to choose lower from here. And that's not just being bearish, but that's just being objective, I think, on where things stand. And where the VIX now below 18 again, we've talked about that as the level. It doesn't stay there for long.
Danny,
so lining up. It
below
almost
17.
Below 17. It almost scares me, Dan, how cheap those S&P puts are.
Yeah.
It makes you, I would never sell them, but it makes you almost like it's too good to be true. But I agree, as a punt or someone that has built up their portfolio here and likes the equities that they own and their quality, not a bad decision here to buy S&P puts, in my opinion.
Yeah, listen, I mean, the flip side of that is, and one of the reasons why I love Tuesdays because we get to talk about the futures. One of the beautiful things about trading futures is your ability to kind of place stops, right? And one of the reasons why we look at so many charts on Tuesdays is also because when you're trading futures and you're using stops, you actually want to look at technical levels, right? Because there's a lot of dealers who kind of keep an eye on these things. There's a lot of traders who hunt for stops, that sort of thing, because they like to trip them off. And I got to tell you, if you were to say put that short on in the S&P futures, you stop them above that February highs. Let's say they get through there, they may go for another 2 or 3%, that sort of thing. And so that's, to me, I like to look at a chart, and Carter does this every once in a while. Sometimes he'll just kind of trick us. He'll flip it around without the name on it, right? He'll turn it upside down and say, what do you think it is? And so that chart looks pretty good right there. So to understand that if you're kind of betting against it, you're being a bit contrarian here. The last thing I want to say on sentiment here, here's a tweet from Carl Quintanilla from CNBC. He's quoting a JP Morgan survey. Danny, look at this exhibit 3. Where do you see S&P 500 at year end? Look at this. Okay. You can do the math on this. All right. It's more than 65%. See the S&P 500, 3,500 or below. And you know where we are right now. We are trading at 4140 or something like that. I mean, that is unusually bearish, just like the data that we had from B of A here. Does that make you feel less comfortable being inclined to play for a move lower? Because it seems like everyone's on one side of the boat here.
Well, look at the other side of that. Those two kind of go hand in hand. If you believe the 10-year, that's a pretty wide range, though, between 1.5 and 4. So that's probably doesn't do it. But below 1.5% on the 10-year, or no, sorry, below 3.5% on the 10-year, 40%, right? If you believe that, that means people believe there's an economic slowdown coming, and therefore people are bearish, obviously, on the S&P 500. So that, to me, is a pretty bullish chart. If you want me to put my bullish equity hat on as an investor, there's that many people on the sidelines, how we started the show, and there's that many people that are in that camp. Something's got to give here quickly, or to your point, Dan, the chase is going to come on, and we will see 4,250, 4,300. So the same way, I know we talked on the tape podcast last Thursday, you and I were kind of going back and forth joking about a straddle, buying a call and a put. If a call is as cheap as the put, which I assume that it is, you just quoted, that not the worst call in the world, because we're going to have to break one way or another. But that's a very bullish stat right there that you're showing me. So
yeah, and then the other one, let's just look at the NASDAQ, the E-mini futures here, because we know that a handful of stocks have kind of been holding this thing up. And on a day like today, where I don't see any of the major names, I see Microsoft down 30 bips, I see Apple up 40 bips, I see Amazon down 0.5%. 0.5%. Google's down 1%. But look at this NVIDIA. And NVIDIA is not a small name here, people. It's trading at new, I think, 52-week highs today. It's up 90% in the year. It's trading up 3%. HSBC. When's the last time you've quoted HSBC, Danny? They had a double upgrade. They were the last sell rating on the stock. So they went from sell to like a strong buy or something like that. And, you know, you look at this NASDAQ, you look at those levels in the futures here, and that's a pretty constructive looking chart, right? Like there's no if, ands, or buts about it. And so tonight we're going to have Netflix. And to me, that's not a huge name. And I think it's very stock specific when you think about just kind of the metrics that they solve to and some of the media players that they're playing against. I don't really see that as tech. We're going to, over the next week and a half, get some of the big platform names, and that's going to be the driver. And then some of the more cyclically oriented names like in the semis. And to me, that will determine whether we get back below that kind of line that we've drawn in the sand there, and then that 200-day moving average back there. That would be healthy. I think the thing about a 17 VIX, Danny, right now, especially even with those sentiment readings, like we're saying, they're saying a slightly opposite thing here. I don't know, man. It just doesn't feel like, without any fear in the market, it's not like you're getting a bargain. You just talked about multiple expansion for about 18 to 19 times, and we haven't even had the recession yet. And when you think about the FactSet data that we quote all the time from John Butters, I mean, if you're looking at forward, earnings multiples for the S&P 500, we're trading right near the 5 and 10-year averages. Does that make a whole heck of a lot of sense, especially with where rates are right now?
Let me just take the NVIDIA upgrade, which I saw it, and you go from a price target of 180 to 360. That's just semantics. That's just for people out there. If you go to your research director and you're a sell side analyst, you say, hey, I want to upgrade this. Well, you got to put your target obviously above where the stock is. And so there was nothing that happened overnight that would justify a change in that, other than he just totally capitulated, or she totally capitulated. I don't know who covers it there. So that's one thing. On the other, Dan, everything's lined up where I think, when you go to the casino and you're at the roulette wheel and the dealer spins the ball around, you have a few seconds to place your bets. And then the hand goes over the wheel like no more bets.
Yep.
I think all the bets have basically been made here. All the charts that you're showing are at the point where either going to move higher or lower. They're not going to stay here. It's very hard for me to see a flat line from here. And it's also very hard for me to see volatility, at least over even call it a month period, remaining at that level with everything going on in the world. And yes, are people now saying, oh, I knew the debt ceiling wouldn't be an issue because you had one day where Kevin McCarthy spoke and he's like, hey, we're going to pass it. I don't think people understand the jockeying that goes on with that. If that was a reason to kind of rally the markets, or people that were hesitant to put money in the market because of it, that hasn't cleared out. So there's a lot more to come. And again, most companies, like let's take example what State Street did yesterday. The reason State Street stock STT got hammered, and I know we don't have the chart of it, was because they didn't tell the street ahead of time what was happening. They weren't communicating. So it was a negative surprise, right? And then even on the call, they said, yeah, in the end of March and the beginning of April wasn't great either. So that was a readjustment. Most of these other earnings that we've seen, we talked about it coming in, 106 of the 500 companies had already basically pre-announced or given you the numbers that they were going to be. A lot of the stuff that's been happening in Bankland is pretty transparent. You can see where deposits are going. It wasn't unexpected. I think we're going to now enter the phase where kind of potluck surprise as far as earnings go, right? And I think the fear in the markets that have been that the banking system was going to, quote, collapse, which was never our thesis at all. Our thesis is over a period of time it will rein in lending, is still what I believe is intact. But you didn't get that on the conference call. You're not going to get that on these quarters. So long-winded way of saying, Dan, I think that we've seen probably the best, or at least the kind of relief rally, if you want to call it, within the sector, because we've seen the banks already go. And now I think we're going to enter kind of the throes of what really matters here, and bottom-up analysis of these companies. And I don't think it will justify these levels on the S&P.
Yeah, real quickly, let's throw up the split screen here. There's two headlines. Goldman reported this morning. Bank of America reported this morning. It's kind of an interesting split screen. So Goldman traders miss out on Wall Street's fixed income boom. On one side, B of A tops estimates as fixed income traders fuel profits. And we've been talking about this on the pod for the last couple of weeks. When you think about where these two banks that are very different banks, right, and where they're exposed, in a different market when the IPO business comes back, when M&A comes comes back, when, like trading in risk assets, you know what I mean, of their customer bases is kind of more normal. A firm like Goldman's going to do really, really well, right? And right now, Bank of America, I think a lot of these firms, probably did well from some of the stuff that they were able to see, some of the deposits they were able to gain during this last period. What was your quick takeaway on just these two names and what they had to say? Because Bank of America seemed pretty comfortable with what they thought the health of the consumer is right now. Goldman really doesn't have that look through.
Well, Goldman, in the area they do have the consumer, they continue to have issues, right? They took a write down in their Marcus, the Green Sky holdings, they took a write down there. They've been distracted, to say the least, on their core business. And so, the IPO market's not hot. The M&A market's not hot. So with Goldman still focusing on that, they didn't have as much trading success, obviously, on the fixed income side. Bank of America, on the other hand, we were talking about this a month ago. There's been options pricing in a dividend cut, options pricing in something going to happen in Bank of America. Again, it didn't, quote, blow up on the call, so it's okay. And of course, they're going to benefit because the big banks are getting bigger, the deposits coming in. They still saw a shift away from, into interest bearing. That's going to squeeze their margins longer term. The consumer is still, quote, okay. Spending patterns look good, not great. And so again, it's not up a lot. It's kind of down a lot. It's kind of a no man's land here, I believe, Bank of America stock, but it's, quote, safe. Goldman Sachs still is cleaning up. And so if you want a pure bank, and we talked about this, when you look at the XLF, why you should, go long and short names within them, because they all face different challenges and they all face a different cycle. So again, Bank of America was fine. Asset gathering was fine. And the trading was decent, probably better than expected. Goldman was the opposite. But, Goldman trades, Dan, at what, 1.2 times tangible book value. It's not that expensive. It's probably fine. So again, completely different complexion for those two companies.
Yeah, and I'll just say this lastly on the banks. I mean, the KRE is a disaster today. It's down 2%, and there seems to be a lot of continued pressure on the regionals here, and it just really feels like there's another shoe to drop. Look at some of these life insurers. They still trade pretty horribly here. So I think some of the enthusiasm or excitement that the major money center banks or the investment banks weren't as bad as some people would have expected. It's interesting that JP is really the only one that made up any meaningful ground here, and this is an area that I kind of want to look to put back out as we get further into Q2 for whatever that's worth. One last one here, Danny. I don't know. I think it was Morgan Stanley was out this morning saying that Blackstone could be added to the S&P 500. The stock was up 5-6%. Look at this chart that we have here. Look at the well-defined downtrend. That was from the all-time high in early 2022. It almost got up there today. It was above its 200 moving average there briefly here. They're going to report, I think, on Thursday morning, and the focus here has been their exposure to commercial real estate, right? I think we talked about it on the pod a couple of weeks ago. They had a sale of a building complex out in California at like 36% below what they paid for, something like that. So this is kind of a story that we've been tracking a little bit. It's going to be interesting as we start to see increased defaults and kind of short sales and all this sort of stuff. Thoughts when you see a chart like this and a company that has the interest rate exposure, the commercial real estate exposure, the default exposure, all the above.
Yeah, listen, the reason the regionals are underperforming is because all the commentary from the banks, even the bigger ones that don't have a huge exposure on a percentage basis to commercial real estate, but they have it, are saying negative things about commercial real estate. There's $4.5 trillion worth of commercial real estate debt out there, of which this year alone, $270 billion is coming up for refi within office properties, right? Which is a lot of where people are exposed. And so there's a huge amount out there. Blackstone, we talked about, from a fee generating perspective, I mean, from, locked up money, 10-year type management fee money, you can model it pretty well. That being said, we know the issues they've had in their B REIT, so to speak, of people of cutting off redemptions and gating redemptions at 5%, obviously per quarter kind of maximum. So it'll be interesting what they say. They're probably still raising money into various real estate portfolios. It's a great company, but obviously this run, if the reason is on today's move that they're going to, quote, be added to the S&P, to me, that's technical in nature here. And I think this is a great opportunity to not be long into the quarter. But again, these are pretty predictable business models, right? You know what their assets are. You know what their fee income is because you can see the realizations which have occurred in their portfolio. So there's not a lot left to the imagination as far as I'm concerned on Blackstone reporting, because people that do their work can kind of predict it. What will be interesting is what they say about the real estate market, Dan, to your point, specifically commercial.
Yeah. And I wouldn't expect them, given the way that they mark things in their B read, I wouldn't expect them to be particularly honest if they're pretty downbeat on it. They don't really have any incentive to do that at the moment. They've had to put up gates, for investors who want their money back, and that's going back to last fall. All right, let's talk about the U.S. dollar here, because this is going to set the stage for maybe a conversation on gold and Bitcoin here. And if we look at the Dixie, or we look at the futures that trade on the U.S. dollar index, this one's kind of interesting to me, Danny. So in February, the dollar was rallying, okay, after just getting demolished from that high late last year, back in the fall. It was basically almost 115, and it got down nearly to 100, and it had that little bit of a rally. And then all of a sudden, we have this regional banking crisis here, and I think the expectation was right that the Fed would start to ease, or at least they would be less inclined to continue to raise. And the dollar sold off pretty hard here, right? So it's at 101.5 or so. You look at that, it's kind of a matched low from that early sort of February low. And I look at this and I say, all right, I got a 200-day moving average up there just above 106. I have that March high just below that, right? 105.5 or so. I see where this double bottom is. I think I want to play for a bounce here. So like using the futures again, I would look to trade this thing. I want to risk one to possibly make 4 or 5 the upside. And why do I like using futures to do this? Because I can place a stop at a technical level just below that double bottom or so. So maybe you want to keep it really tight. If it's trading at 101.5 here, maybe you want to do 100.50 as your stop to the downside and look for a move back towards that kind of 105, 106 level or so. And then what I would continue to do here, if it starts going in the direction that I want it to, I'd continue to raise that stop, right? And so if you keep seeing the price going in your direction and you keep raising the stop, you're basically locking in whatever gains, or you're minimizing the potential loss. So I like the risk reward here, especially if you think that maybe the move that we've seen in the dollar is already anticipating the Fed at the May meeting, suggesting that, okay, they went 25, but maybe the language is going to suggest they pause. And that's not exactly the thing that crushes the dollar, because to me, I almost think that that's kind of worked into the price right here at this level, which I think is an important level, that psychologically 100 level, Danny.
Yeah, listen, we've talked about it's the euro and the yen are the two biggest inputs to this, what you're looking at here on the dollar here. And if you're bearish on the S&P, you kind of have to be bullish here on the dollar, in my opinion, because what's the one thing that's made the S&P rally, to your point, has been the belief that the Fed is probably done, or 25 pips and done. I mean, even today, Goldman Sachs came out and said that the ECB, they believe, will go another 25 basis points more than they had originally thought. I think thought they were going to stop at 3.5%. They may go to 3.75. All of a sudden, you have this complacency in the markets that may allow central bankers to be a bit more hawkish than they had expected. To me, that does not portend well, potentially, for the U.S. dollar. In terms of it weakening from here, I actually think it's going to strengthen. So if I think about the run that gold has had, and I'm obviously very bullish on it for many other reasons other than just the U.S. dollar, it's hard to sit here and say with a straight face, if I think the DXY is going to go to 105, that gold's not going to retreat somewhat, because it probably will, just on a knee-jerk reaction. But I think the dollar doesn't have much more downside from here. And I think, Dan, the debt ceiling issue is having a direct impact on the dollar as well.
Yeah.
If we get that resolved, the value of the dollar, I would think, inherently would move higher as well.
Yeah, and let's just pull up this gold chart really quickly here, because you and Guy have been kind of all over this move of late, and so the idea of playing for a back and fill makes some sense. We've introduced a trade using the futures, again, using sort of tight stops here. Guy was talking about it last week. I would almost kind of have a stop at that kind of February high, somewhere like 1960 or so. I know that you guys think there's a whole host of reasons why this thing could just break out above what was that kind of double top-ish level just above 2000, where we just were, going all the way back to last year or so. But to me, gold definitely looks interesting if it were to back and fill a little bit, because I'm not in the belief that we're going to wake up one day, it's going to be up 200 points or something like that. I think it's one of these things that trades very technically. All right, last thing before we get out of here, Danny, we've also been talking a lot about oil. That weak dollar, right, has benefited oil. We did a trade idea here. We were looking at that 200-day moving average. We were looking at the resistance level in the futures that you see right here. It's having a tough time, as it should right here. It feels like it could break either way, one way or the other. Do you think this is a function of the dollar? Do you think it's a function of expectations about just kind of weak demand in a meandering economy?
I think it's no man's land. Again, It's trading on OPEC cuts,
Yep.
right? It's trading on economic slowdown potentially happening. If the Fed is actually done and the economy is okay, this oil, in my opinion, is going to go much higher because of all the geopolitical risk that's kind of associated with it. But again, I've said this. This is an input, I think, into earnings stream and cash flow streams for a lot of energy companies out there. And again, that's going to be, to me, the one sector that's going to shine right in this quarter that's going to, about to report. Because even if you were to take oil to $70 or $75, in my opinion, there's a lot of energy stocks out there that are cheap. And just a shout out on a coal company, BTU, that Porter and Vinny, as we know, have been buying. They were talking about capital return. They announced over $1 billion buyback. The entire market cap of the company is $3.6 billion, 2.5 times EBITDA, 4 times earnings. So there's stuff out like there where you start to look at charts like this that makes sense no matter what the level of the commodity is. But again, another chart that's in no man's land that's probably going to pick a direction, Dan.
Yeah. All right. Thanks, Danny Moses, for stepping in for Guy Adami. He will be back with me on the Friday on the Tape podcast. You can check him out every Friday on that. Thank you guys for being here. Sorry we didn't get to any of your comments. We had a lot of stuff to do. We had to get out of here on the screws, as Guy would say, at 1:30. So that's going to do it for today's market call. Thanks to CME Group for sponsoring this episode and to FactSet for providing all of the charts and data. Carter and I will be back tomorrow at 1 p.m. So we'll see you then. Thanks for being here. Thank you, Danny Moses.
Thank you, guys.
All right,
thanks, Dan.